Hello viewers, welcome to my channel. I'm Hasham. This is the second video on capital gain. The last video I have explained you about the meaning of the term capital gain and what are capital assets and assets which are deemed, that means deemed to be capital assets. These are the topics I have already explained in the last video. Now in this video I am going to explain you about the nature of capital asset, amount, advance money received and forfeited, and what is transfer, what do you mean by transfer of asset, and how to calculate the capital gain. So these are the topics I'm going to explain, and I already told you the problems are based on the theory. If you are strong enough on theory concept, then easily you can solve the problems. And even in examination, they will ask you theory question regarding what do you mean by transfer of capital asset? What do you mean by capital asset? What is the nature of capital asset? So apart from problems, theory questions may also be asked in examination. So watch the video till the end, don't skip in between. So before explaining in detail, take the screenshot of the points which I have written on the board. Now, nature of capital asset. So what do you mean by capital asset? Already I have explained the last video. Any type of property, whether movable or immovable, tangible or intangible, fixed or circulating, and examples of those assets which are not taxable, like personal effects, agricultural land in rural area. These are the things which are not taxable. So here the tax liability, that means the taxability on capital gain depends on the nature of capital asset. So broadly we divide the capital asset into two categories: short-term capital asset and long-term capital asset. Again, in examination theory may be asked, explain about short-term and long-term capital asset. The nature of capital gain is the basis for determining the tax. That means the tax on capital gain depends on the nature, because the rate of tax is different for short-term capital gain and long-term capital gain. Generally, the long-term capital gain is taxed at a flat rate of 20%. This is the normal rate. Whereas short-term capital gain is taxed on slab basis along with the other incomes like income from salary, income from house property, income from business or profession. These are the other heads of income. Along with the other heads of income, short-term capital gain will also be included. It is taxed at slab basis. But under certain special circumstances, the concessional rate like 10%, 15% will be applied on short-term capital gain also. Now, in order to understand when we apply the short-term, when we apply the long-term, we divide the assets into two categories: non-financial assets and financial assets. So first we discuss about non-financial assets. Example of non-financial assets are land, building, equipment, jewelry, etc. These are the examples of non-financial tangible assets. Now first we discuss about land and building. So if land or building or both is held by the SSC for a period of less than or equal to 2 years, this is very important. If land or building or both is held by the SSC for 2 or less than or equal to 2 years, then it will be treated as short-term capital asset. If the SSC has hold the asset for more than 2 years, then it will be called long-term capital asset. Suppose if an SSC has purchased a house and within 1 year or within 2 years he sold it, it's called a short-term capital asset, and the gain arising is a short-term capital gain. Suppose if a person purchases a land, building, etc. and hold it for more than 2 years and then sold away, it's a long-term capital asset. Gain arising is long-term capital gain. So deciding factor, 2 years or less, it is short-term. More than 2 years, it is long-term for land, building. That's it. Next comes other non-financial assets. Other than land and building, the period is 3 years. If any other non-financial asset is held by the SSC for 3 years or less than 3 years, it is called short term. If the holding period is more than 3 years, then it is called a long-term capital asset. So land and building 2 years period, other non-financial assets 3-year period. Less than 3 up to 3, short term. More than 3, long term. Next comes category B, that is financial assets. So what are the financial assets? Equity and preference shares, whether listed or not. And equity and debt oriented funds of mutual funds, UTI, zero coupon bond or debentures, bonds and government security. These are the examples of financial assets. For the sake of understanding the taxability of financial assets, we divide it into 3 categories. Category A, B and C. A category are these are the items. Which are the items? Security, other than units, other than the units of mutual fund, listed in a recognized stock exchange. So any security which is listed in a recognized stock exchange other than the units of UTI, mutual fund. Then units of equity oriented funds and units of UTI. So any units of equity oriented of mutual fund and the UTI. Then zero coupon bond. So these 3 items will come under category A. Category B, unlisted shares. And category C, units of debt oriented fund, unlisted security other than shares and other non-financial assets. Any other non-financial assets will come under C category. Now what is the taxability? Taxability of gain or loss on sale of financial assets. If these financial assets are sold, then what is the taxability? Category A. If held by the SSC for a period of less than or equal to 1 year, then it is considered as short-term capital. Holding period is 1 year. For which assets? A category. Security other than units listed in a recognized stock exchange or units of equity oriented funds of mutual fund and UTI, zero coupon bond. For these 3 cases, the holding period is 1 year. If an SSC hold these assets for 1 year or less, it is called short term. If the SSC hold these securities more than 1 year, it is called long term capital asset. And the gain arising will be long-term capital gain. The holding period 1 year for category A items. Now category B items, if held by the SSC for a period of less than or equal to 2 years, then it is considered as short term for category B. In category B, unlisted shares. For unlisted shares, the holding period is 2 years. If the SSC hold the shares for 2 years or less, it is called short-term capital asset. Gain arising short-term capital. If the SSC hold it for more than 2 years, it is long-term capital gain, which B category. Now C category. If held by the SSC for a period of less than or equal to 3 years, then it is considered as short-term. Here the holding period is 3 years. Which one? C category. Units of debt-oriented funds, unlisted security other than shares or any other non-financial asset. For this category, holding period is 3 years. Again I repeat. Category A, 1 year. Category B, 2 years. Category C, 3 years. Right? This is the taxability. Now note, some provisions are given by the Income Tax Act regarding the long-term capital gain on shares. On shares. So how to compute the tax on long-term capital gain on shares? So if the listed shares or equity-oriented units are transferred through recognized stock exchange, so Income Tax Act says, if the listed shares or equity oriented funds are transferred through a recognized stock exchange on which STT is payable, security transaction tax. So whenever shares are bought and sold at a recognized stock exchange, then STT will be applied. Security transaction tax has to be paid for purchasing and selling the security in the stock exchange. So here what Income Tax Act says, if the listed shares or equity oriented units are transferred through recognized stock exchange on which STT is payable compulsorily, then LTCG in such security exemption is given up to 1 lakh. Income Tax Act says. If the long-term capital gain is up to 1 lakh rupees, it is exempted. if the shares are listed in a recognized stock exchange on which STT is payable, then long-term capital gain up to 1 lakh rupees is exempted. Over 1 lakh rupees capital gain is taxed at a flat rate of 10%. At a flat rate of 10%. So remember, very important point you will come across in many problems in the coming videos. So if long-term capital gain arised on sale of shares in a recognized stock exchange on which STT was paid, in that case up to 1 lakh rupees capital gain tax free. Over 1 lakh rupees capital gain, long-term capital gain, taxed at a flat rate of 10%. Now, if the listed shares or equity-oriented units are transferred privately, suppose if the shares are there, but the shares are not sold in the stock exchange, the shares are sold privately or in an unrecognized stock exchange, then the provision says on which STT is not payable. STT is payable only if the shares are bought and sold in a recognized stock exchange. If the shares are transferred privately or if the shares are transferred in an unrecognized stock exchange, then STT is not applied. When STT is not applied, the SSC is given an option to pay tax on LTCG at 20% with indexation and 10% without indexation. That is, minimum of the two amount is the tax liability. What is indexation? Next video I am going to explain. Right now you remember, if shares are transferred privately or in unrecognized stock exchange on which STT is not paid, the long-term capital gain is taxed at 20% with indexation or 10% without indexation, whichever is minimum. That option is given by the Income Tax Act to the SSC. Suppose I am the SSC. I will calculate what is the tax liability of LTCG at 20% with indexation and 10% without indexation. I calculate both. Whichever tax liability is less, that option I will opt. I will choose. Next, advance money received and forfeited. Sometimes in the agreement of sale transaction, some advance money is received from the buyer. Suppose I am the seller, you are the buyer. We have agreed into an agreement that you are going to purchase my property for rupees 80 lakh and the advance money you have to pay 5 lakh rupees right now, and the sale transaction will be concluded in 3 months. So it is your responsibility to pay the remaining amount in 3 months and complete the sale transaction. If you fail to complete the transaction, that money which you have paid, advance money, will not be refunded. It is forfeited. So Income Tax Act says if advance money is forfeited in a sale transaction, it is considered as income from other sources. If the advance is received after 1st April 2014, this is the date. So if advance money is received and forfeited after 1/4/2014, then the advance money is taxable under income from other sources. If the advance money is forfeited before 1/4/2014, it should be deducted from the cost of acquisition. The deciding date is 1st April 2014. After 1/4/2014, income from other sources. Before 1/4/2014, deduct the amount from the cost of acquisition. That's it. Next comes transfer of capital asset. Actually, capital gain is taxed whenever capital asset is transferred during the previous year, relevant to the current assessment year. Our current assessment year is 22-23. Previous year is 21-22. So during the previous year 21-22, if the SSC has transferred the capital asset, then only capital gain tax. If there is no transfer, no capital gain. So you must know, what do you mean by transfer of capital asset? In examination theory question, very frequently it will ask you, explain about the meaning of the term transfer of capital asset. So transfer of capital asset includes the following. First one, sale. The sale is the common or most popular transfer of asset. The ownership of an asset is transferred on selling the asset. Example, I am the owner of a house property. I have agreed to sell to you for 80 lakh. You are paying the price 80 lakh. I am giving my house to you for 80 lakh. This is a sale transaction. It is a transfer of asset. Secondly, exchange. Sometimes there is no sale but exchange of one asset with another asset. Example, I am having a property worth rupees 80 lakh. I am selling my house property to a company. The company is giving the shares to me. So I am parting away my building to the company and company is giving me shares. There is exchange of property with shares. It's called exchange. Income Tax Act says exchange is also transfer of asset. So if any gain arising on exchange is also taxable because it's a transfer of asset. Next comes relinquishment. Relinquishment means voluntarily transferring the ownership of the asset in favor of another person. Example, a partner has transferred the ownership of his property to the partnership firm. So voluntarily he is transferring his property in the name of the firm. It is called relinquishment. Voluntary transferring the asset, ownership of the asset in favor of another. Next comes extinguishment. Extinguishment means the ownership is transferred by operation of law. By operation of law, ownership is transferred. Example, in case of life insurance company, the insurance company will get the ownership of the damaged goods once the amount of claim is paid to the policy holder. So when the event occurs, like fire occurs, after fire, whatever claim the insured has given to the company will pay the insurance amount. After paying the amount, the damaged property will belong to the insurance company. The insurance company will take over the property, damaged goods, as per the extinguishment. Next comes compulsory acquisition. Many a time, the government will compulsorily acquire the property from the assessee. Compulsory acquisition. Example, the government has acquired the land of the assessee for laying the railway track. Government wants to put the railway track or master planning. The government wants to widen the roads, master planning. So government wants to compulsorily acquire the property. That is also transfer of asset. Then conversion of capital asset into stock in trade. Sometimes an assessee will convert his capital asset into stock in trade. Example, a person has purchased gold for rupees 5 lakh 10 years back for the purpose of just an investment, jewelry. He has purchased the jewelry for his wife, so it is used for personal purpose. But later on, after 5 or 10 years, he has started a business of gold. He has started a gold shop. In that gold shop, whatever personal gold is there, that he has put as stock in trade. At the time of converting the capital asset into stock in trade, the value of the gold is 8 lakh. When he has purchased it, it was 5 lakh. But when he converted that property from personal property to business property, it's 8 lakh. So 3 lakh rupees is the capital gain. The market value is 8 lakh. Purchase price 3 lakh. He is converting the capital asset into stock in trade. 3 lakh is the capital gain. It is taxable. It is taxable. So these are the cases of transfer of asset. Sale is a transfer, exchange is a transfer, extinguishment, relinquishment, compulsory acquisition, and converting the capital asset into stock in trade. This is the theory you have to write in examination. Lastly, capital gain. Profit arising on the transfer of capital asset is called capital gain or capital loss. So whenever the capital asset is transferred and gain arises, then only it will. If there is no capital asset, no capital gain. If there is no transfer of capital asset, no capital gain. So the difference between the consideration received and the cost of acquisition is the capital gain or loss. The difference between consideration received and the cost of acquisition. Example, I have sold my property for rupees 80 lakh. I am getting the consideration 80 lakh, whereas the cost price of the property is 50 lakh. So I have purchased the property 50 lakh. I sold the property for 80 lakh. So 80 minus 50, 30 lakh. That is the capital gain. Suppose if sale consideration is less than the cost, there may be capital loss. If sale price is more than the cost price, the difference is called capital gain. When the selling price is more than the cost of acquisition, there is a capital gain. If selling price is less than the cost of acquisition, there is a capital loss. Lastly, note, if transfer expenses, selling expenses, brokerage paid, etc. are there, the same should be deducted from the consideration receipt. Example, sometimes to sell the asset, the SSC has incurred some selling expenses, brokerage paid. That selling expenses, brokerage paid will be deducted from consideration receipt. I sold the property to you for 80 lakh. For selling the property, I have given advertisement. I am paying the brokerage charges. So whatever advertisement, brokerage, selling expenses I have paid, that will be deducted from consideration receipt. And from the net consideration, cost of acquisition is deducted to get the capital gain. That's it. So in this video, I have explained you about the nature of capital asset, then amount forfeited, advance money forfeited. Then I have explained you about the transfer of capital asset and what is capital gain. Inshallah, the next videos, again, I'll continue some more theory. Then after that, we'll start the problems. So if you're satisfied, give a like to the video, share my channel among your friends, among your groups, so that more students can watch the video and enhance the knowledge. Subscribe my channel if you have not yet subscribed, and by the super thanks which is given below my video. Inshallah, we will continue the next topic in the next video.